for those that are again just brand new, they what is this? What are you guys even talking about? What's velocity banking? You know, you like give it to us short and sweet, like quickest, shortest breakdown of velocity banking, and then we'll break it down for we'll go into more details.
Velocity banking is borrowing from Peter to pay Paul, where when you borrow from Peter, you're being charged zero to low interest compared to what you paid off Paul by. So Paul is your high credit cards. Paul is your high student interest loans, your amortized loans, personal loans, IRS debts, car loans, right? That's Paul. Peter, right, is your handy dandy 0% credit card, personal business, your handy dandy home equity line of credit from your home at a relatively low rate, or a personal line of credit. So Peter is banking products that can be used for your advantage rather than just the bank's advantage. So borrowing from Peter to pay Paul, where when you borrow from Peter, he charges you zero to low interest costs to pay off Paul that was beating you up over the head with high interest. And it creates what's called an offset, right? You're a net positive arbitrage of borrowing debt from this location to pay off debt in this location. All that cash flow that we just redirected, that we're no longer paying Paul, right? We're now going to pay Peter because Peter's charging us less interest, which means less interest means more cash flow for you, principal, to pay Peter off in full. And that's the key. At the end of the day, we want to be done with Peter and Paul and just focus on Jesus, okay? In a nutshell. But like, you want to be done with all of them.
Right.
All the institutions. You don't want to be controlled by those institutions. So I'm showing people how we can not only eliminate debt in our lives, but become masters over debt and learn how to leverage like King Solomon leveraged
Right.
many years ago, and how many other successful kings and queens and presidents and prime ministers and entrepreneurs and CEOs and banks and life insurance companies, everybody is leveraging,
Right.
right? And so understanding, comprehending how to effectively leverage your time, talent, and treasure to multiply your fruit is a valuable asset, a valuable skill. And that's what velocity banking does at a very, very fundamental foundation level that anyone with enough time and patience can develop the skill, just like this Puerto Rican kid from nowhere learned, right?
Right.
So if I'm convinced if I can comprehend this stuff, anyone can.
So what impressed me about velocity banking the first time you taught it to me was that the fundamental principles of velocity banking have to do with being a good steward. Would you agree with me on that?
Absolutely. Yes.
Exactly. And you have to know the basic principles and fundamentals before you start, moving money around and borrowing from Peter and paying Paul. So can you kind of go over some of the basic fundamentals? If I'm looking to start this debt elimination strategy, what's the first thing I need to do?
First thing you need to do is know your numbers. That's probably every video I ever put out, even those in the comments. We got Wendy's in the house, and Alfredo, and Eric, and Andre. They know, as well as those who are brand new that are seeing me for the first time, that you will constantly hear me say you need to know your numbers, because I still have clients and people that have been following me for years and years and years. And it's a constant refresher, reminder that, hey, there's a time where you might just forget your numbers. There's times where you might fall off, okay? You might backslide. But establishing that discipline to reduce the amount of times that you don't know your numbers is going to increase the amount of times that you can successfully make an educated, informed financial decision over your life and your family's life. So I'm just increasing probability in your favor by just starting there. Know your numbers,
Knowing your
right?
number.
Second fundamental foundation, after we know our numbers, we're able to fully comprehend where we are at, right? And how we can move forward. From there, we're going to look at your net cash flow per month. That's part of your numbers, knowing your numbers. There's 4 major numbers. There's your income, your expense, your total debt, and your net cash flow, aka discretionary income. There's a lot of different terms that can be used for the word cash flow. Money left over after all bills, debts, tithing, saving, investing, after everything is done, what's left over, all right? In my brain, cash flow is unpurposed funds, right? You haven't given it a purpose yet, so therefore it is a remainder of that month. And now we have to make a decision every single month, every single paycheck for the rest of our days. We have to make a conscious decision to give that money a purpose, right? Give that money a job. If we do not manage, steward, then we are releasing our authority over that money. And now that money is going to have authority over us because it has the ability to tempt us. Money has the ability to deceive us, to make a fast decision like buying that Gucci belt or buying that Coach bag or any Louis Vuitton, any type of expensive item or vacation or whatever it is, food, it could be anything, right? So being able to know your numbers is extremely important. I don't, when someone becomes a client, they're not doing velocity banking with me right out the gate until I know the numbers, they know the numbers, we can articulate the numbers together and then move forward to the next step. So next step is, okay, we got our cash flow. And we're going to determine our chunk amount to actually do velocity banking with.
Wait, hold on.
In
Hold on. Hold on, hold on. You
Yeah.
just jumped ahead there. So hold on. Again, I don't know anything about any of this stuff here. Okay, I got it. I got to know my 4 numbers. Okay, got to figure out what my discretionary income is. I have to have a purpose for my money, right? Um, and otherwise, it's gonna, have authority over me. Now, before we go into the chunking and all that, um, someone who's struggling with debt, um, how important would you say tithing is, even when somebody is struggling?
I wrestle with that myself. I mean, between different Christian denominations, I honestly try to evaluate who I'm talking to. If I'm talking to a devout Catholic, a devout Christian, and they already have the discipline of tithing, then it's not really much of a conversation. If I'm dealing with someone like myself that maybe doesn't know all the scripture and maybe is asking a genuine question like, hey, I'm torn between giving my first fruit to God or giving my first fruit to this debt institution so that I can be free of that chain so that I can give more to God later on, right? So depending on which doctrine you listen to, there's a group of Christians, group of Bible believing folks that tithing is not is no longer a requirement, rather it's a means it's a matter of the heart, and then giving an amount based on what your heart desires to. So you have this desire to give to God. And then on top of that, within that group, tithing doesn't always necessarily mean money. There can be an alternative, such as your time, right? And we hear so many creators say time is money, right? We hear that. So it really does depend on who I'm talking to. For myself, when I was in debt and I did not know the word as much as I know now, I was not tithing any dollar amount to a church, right? I was not giving any dollar amount to God. My sole focus was, I need to eliminate all this debt here so that I can be a better, more cheerful giver, right? And hey, that's something that I think everyone that is a believer needs to read the word for themselves, needs to understand what it says and what it's saying. We need to do word study. We need to understand, where does tithing even come from? When did it start? When did it get established? What did the New Testament have to say about it? So it's tough. It really is tough. I would argue that the person that does tithe, not just to fulfill a law or not just to fulfill a command, but someone that tithes from their heart and they have a relationship with the Father, and they're getting clear divine inspiration, message, communication from the Father, and the Father says, give this money to this location, give this money here, and I will supply you your needs. I'm not going to argue with that, even if it doesn't logically make sense. I have people in my life, specifically a brother in Christ that I know, who I won't name, that when we were doing coaching calls together, I'm giving him logical strategy, right? And it's great and all, everything that I was sharing with him, but it didn't overrule what God was telling him to do. So whenever I'm talking to a believer, I usually allow Holy Spirit to give us a financial game plan. And if it involves giving 30% of their income to some random dude on the street, I'm not going to argue with that. If they've been told by the Father to give this money here to this organization, show up at this time at 3:00 to give this money here, and I will bless you, or I will cover all your needs, right? Now, that is an act of faith. I think that is extremely important. I would not shut that off.
Right.
If someone is in massive amount of debts, and you're getting a strategy from a guy like me or any guru online that you're working with, but then the Father is giving you a plan as well, and the Father says, hey, this next paycheck, I need you to walk into this location at 4:00, give the entire paycheck to this person so that I can unleash the resources to cover the next 6 months of your life, right? The next 9 months. Like, I do believe God is a God of order and operates in specifics and gives clear, abundant instructions. And if we were to just have faith in that before we see the result, before we see the game plan, dude, that's a strategy in and of itself, right? I will not interfere with that, right?
Okay.
I will just share that in my personal journey, I didn't give, I didn't tithe, paid off all my debt. And then I went back, calculated the math, and said, okay, here's how much I want to give to make up for that time that I wasn't giving. So now I'm doing like a double give, and I'm always working towards how can I give more? How can I give more? How can I give more?
Awesome.
Right?
Yeah.
Yeah.
Awesome. Good. All right. Okay. So um, we got our numbers. We're gonna start, trying to pay off debts. How important is having good credit before,
Yeah.
in this beginning stages?
Yeah. So I have a playlist on my channel called Velocity Banking Pregame Work before we even do velocity banking. Right? Got to know your numbers. After your numbers, part of your numbers is knowing your credit score. We need to have good or decent credit. Decent credit, to me, 650 or higher. Good credit, 720 or higher. Anything above 720, you're going to get access to better rates, better tools, better offers, better deals, period. That is going to influence how effective velocity banking will be, right? From just the perspective of the tools itself that's required, velocity banking, in order to do it, requires tools from the banks, right? So I need credit.
Right.
I need good credit, preferably great credit, amazing credit, to get access to the best deals,
To get to the best tools.
get to the best tools. If I have the sharpest knife, the sharpest, tool, I'm gonna get the job done faster, more efficiently than the guy that comes with a dull knife, right? If I got a sharp knife, you got a dull knife, I think I might cut you faster than you might cut me, right? Or I think I might cut my steak faster than you might cut yours, right? So I'm just working faster than you. That's as simple as it gets. So a lot of people try to rush this, and I'm such a fan of pregame work. I'm an even bigger fan of a pre-strategy before the strategy. A pre-strategy to velocity banking can be debt snowball, possibly debt avalanche, almost never, but it's there. So debt snowball, debt avalanche, and cash flow index. These are the three most popular ways of eliminating debt that does not require credit, does not require you applying for anything. It's just purely based off your four major numbers and your discipline to purpose that cash flow each and every month from your paycheck or your paychecks,
Right.
right? So all of that work can usually take about 6 to 9 months before someone even implements the concept. So there's a learning curve,
Mm-hmm.
then there's the preparation curve, and once those two things are complete, then we can actually get into the concept. So if we wanted to assume that people here watching have already know their numbers, already been paying off debt, they've got good credit, they have a debt tool, right? Either a PLOC, credit card, HELOC, right? One of those three is usually what we're using for the most part. And you can be usually a combination of the two, like a credit card and a PLOC or a credit card and a HELOC, right? Let's say we have the tool,
Mm-hmm.
then we can get into my step about determining what our chunk is going to be, figuring out our leverage. How much are we going to leverage? How much are we going to use in this environment
So,
to
but let's clarify that now. When you say chunk, okay, like exactly what are we doing now? We're gonna do
right.
what? So I have the line of credit, I have the HELOC. So we've kind of gone past the pregame work. I'm ready to start, um, and I'm gonna I'm gonna bite a chunk of what am I doing here?
Right. So I'm using very, very low grade words to not lose people in a sense, right? So chunking is another word alternative to using the word lump sum, right? Or a cash withdrawal from the line of credit,
Mm-hmm.
right? So chunking is just a short way of saying, hey, we're taking a lump sum money out of that debt tool that we just acquired. We're borrowing from Peter, and now we're going to go pay off Paul, right? So to figure out, all right, I got this $50,000 HELOC. Should I borrow the whole 50,000 out and pay off 17 credit cards over here. Is that the smartest? Should I really do that? Right? We're able to evaluate what makes sense, what doesn't, right? What is efficient, what is not. So developing that chunk amount involves a few factors. One, your cash flow per month times 12. We have that number. Then the line of credit balance amount, the credit limit, say it's 50 grand, times that by 66%, right? 2/3. And you're going to develop your chunk range. So if my cash flow in a year is $20,000, and I got a $50,000 line of credit, home equity line of credit, 66% of that 50 grand is $33,000. So anywhere between 20,000 and 33,000 is my chunk range of how much I would leverage to eliminate debt. Ideally, however much we use must offset whatever interest that we're going to pay when we say borrow that 20 grand or that $33,000, right? So that really helps us qualify how much we're borrowing at what cost, what interest cost, right? A lot of people look at interest rates, and it's pretty easy if you have a 10% loan here and I can move it to 5% here. That's a no-brainer. Yeah, boom, that's called debt consolidation. Right? Except the traditional way of debt consolidation comes typically with fees, origination fees, and sometimes can involve your credit tanking in order for that company to work with you, to consolidate all their debt and to put it with their institution. And sometimes they'll do a little sleight of hand. They'll put out a low rate in front of your face that's lower than all the rates that you have on your debts, and not realizing the time that you'll be owing them. And what ends up happening is the amount of time that you owe that debt consolidation company, you'll end up paying them more interest than if you would have just stayed with the companies that you owed in the first place. That happens way too often.
Right.
So I'm showing people how to do basically debt consolidate by not hiring a company, right? Fixing your credit, accessing a better tool than a debt consolidation tool from the institutions, right? And paying a much, much, much lesser cost, right? With that in the process.
So,
right? And
how much, how important is it for me now to really understand interest and how interest works for this to make sense? Because on the surface, a lot of people, who just really don't understand interest, I think they hear this and they just say, well, it just sounds like you're making me do a lot of work. Why don't I just take my extra cash flow and just dump it into my debt? Why do I need to do this line of credit thing and chunk? How is that outperforming me just throwing my cash at the debt? I know that the answer is, I know what the answer is, but if you could explain to us, first of all, maybe talk about, just interest in general, the different types of interest, because maybe that might clear up for people in understanding why this strategy actually works over time and speeding up the paying off of debt. If you could touch on that.
so to touch on why should I even do this in the first place? Why don't I just make extra payments? Whenever I have a conversation with someone that hasn't yet had that light bulb moment or that shift, usually I like to keep them where they're at and say, yes, keep doing that. Keep making extra payments, right? Keep doing it and continue to watch my videos so that you can learn more about interest costs. I would rather you stay here than try to come into my land, make a mistake, and
Right.
then blame the land that you came into, and you don't know the jurisdiction, you don't know the rules, you don't know the protocols, you don't know the regulations, you don't know how things work here. All right, that's like me going to China and thinking that I can do some of the things I can do in America. I might end up in jail, right?
Right.
Or me going to a Muslim country and thinking I can, do things that are not in alignment, right? That can land me in jail. So
Mm-hmm.
that's something just very easy. Like, hey, for the most part, I don't want you to just jump into velocity banking, which is why my videos go into such depth when it comes to the numbers and the calculations. I want you to get just as proficient as I am when it comes to running the numbers before you even do what I'm saying. So put that aside. Let's say someone's like, hey, I'm in. I like this. I want to do this. I've done the pregame work, everything, but
Mm-hmm.
I'm like stuck on the interest. I'm stuck on how to make sense of borrowing at 9.5% to pay off my 7% car loan. I'm just having a disconnect there, right? There's something I'm not understanding,
Right.
right? Now, to alleviate the pressure, sometimes that won't make sense. Borrowing from 9.5 to pay off 7%, sometimes it will not make sense if you would have just made extra payments on the 7% car loan, right? So here's what we do. We simply pull the amortization schedule of your car loan at 7%, right? And we can see how much interest is left on that car by just making the normal car payment, right? And if you were to run the math based on the amount of interest over that amortization schedule of your car loan, you will not come to the conclusion that you paid 7% on that car loan. You'll come to the conclusion that you might have paid 34% when you actually run the math compared to the total amount paid, right? In comparison to principal owed, and you'll see, wait a minute, over this lifespan of this car loan, I'm going to pay $9,000 in interest. That's roughly 28%, but my car loan says 7%, which when I do the math, 7% is actually $4,000. Why am I paying 9, right? So once we pulled that amortization schedule, we say, hey, your actual cost is 34%. They showed you 7, you're actually going to pay 34% over the life of this loan, right? Therefore, let's run it again, making extra payments, right? Let's say making extra payments, we're able to bring that 34% cost down to an actual net cost of 6%. Or maybe 5.5%. So they said you were going to pay 7 because you paid extra each and every month. You paid the car off early. You actually paid about 5.5% in net interest costs. So now we know, now we have our measurement stick, right? Making extra payments or debt snowball is your measurement stick to determine whether or not velocity banking will make any sense, right? So we just went over Peter's debt, right? No, I'm sorry. We went over Paul's debt, borrowing from Peter to pay Paul. Went over Paul's debt was the car loan at 7%. It actually cost me 35% over the life span of this loan. If I make extra payments, I'm going to end up paying 5.5%. Great. Velocity banking I've got this 9.5% home equity line of credit. It's at a higher rate than my 7% amortized car loan. Well, what most people do not know is that 9.5% home equity line of credit, we don't actually have to pay that rate when doing velocity banking. We can actually pay a net lower cost, which would result in a lower rate over the span of, say, 1 year, right? Or 6 months or 9 months, however long it takes me to eliminate that vehicle. So when we're running the math, all we're looking for is if I borrow from 9.5% on my home equity line of credit, and I end up paying 2.5% in net interest costs for that year, then 9.5 just became 2.5, making extra payments at 7% became 5.5. So now we're dealing with actual costs versus interest rate. So I get people to understand the math behind your actual net interest costs, right? Hey, if we can't reduce 9.5 below 5.5, don't do it. Say, hey, now you're forcing the concept to work in your favor. You might make a mistake. Not pretty.
Right.
But if I can turn 9.5 down to 2.5, then I have more money going to principal. Hence, I pay off the debt faster. How much faster, you might ask? What's valuable to you? If it's any amount, right? Some people are pretty satisfied, but hey, if you're telling me I can go any amount faster than what I'm doing, I'm in.
Right.
Some people are like that. Me, I'm a little more picky, right? If making extra payments, debt snowball, has my car paid off in 3 years, and then doing velocity banking, my car will be paid off in 2.9, not so much worth it to me. The results are pretty close. I'm like 2 months faster, 3 months faster. Now, you tell me that I can go from 3 years to 1.5 years, 2 years. That's, to me, anything that's 20, 30, 40% faster than the traditional way is very attractive to me. If it's only 5% faster, 7% faster, maybe 10%, it may not be worth the headache,
Right.
especially dealing with a new individual, a new practitioner to the concept. They might make a mistake. That mistake might cost me 4 months. There goes my window, right? But if we set out, hey, 3 years as opposed to 1.5 years, even if I made a mistake, I'm still ahead of you, right? And say I make a mistake and now I'm at 1.9 years, I'm still over a year faster than the person making extra payments. Pretty powerful.
Awesome. All right. Well, Denzel, thank you so much for your time today. For all of you, anyone watching now or later, if you'd like to take advantage of a special promotional offer, Denzel has given me a link in the description below that you can take advantage with a special promotional code Sebastian. And so just take a look there. But, as he said earlier, you can digest hundreds of hours of content for free on his YouTube channel. Get educated. Make sure you take your time. There's no rush to jump into an empty pool. You want to make sure that the pool is filled and it's properly, has all the right chemicals. Everything is set up properly before you dive in. So take your time. And again, Denzel, thank you so much for being with us tonight.